There is a mathematical formula that I used to turn zero into $160 billion managing Bridgewater. And I'm going to show you exactly how to apply that same formula to accumulate $30,000 in 6 months, starting from zero or with very little. But first, I need to warn you something that's going to sound brutal. 93% of the people who will watch this video until the end are going to do absolutely nothing with this information, because the truth about building wealth quickly requires you to accept a reality that your brain is programmed to reject. In the last 45 years of navigating the markets, I have observed that the difference between those who accumulate money quickly and those who remain stagnant is not intelligence, it is not luck, it is not initial capital. It is the brutal willingness to accept that everything you were taught about saving money is fundamentally wrong. The idea of saving 10% of your salary and waiting decades is mathematically insufficient for most people to achieve financial freedom before the age of 60. If you earn $3,000 a month and save $300, it would take you 8 years and 4 months just to accumulate $30,000 without counting inflation. And that's assuming zero returns, which means that in practice you will never get there because average inflation of 3% a year eats away 15% of your purchasing power in those 8 years. The brutal math is this. The traditional method was designed for an economy that no longer exists, where jobs lasted 30 years, pensions were guaranteed, and inflation was below 2%. We are in 2026. Where the real interest rate after inflation is often negative, where the expectation is to change jobs every 3 years, and where economic volatility means that waiting decades is a gamble that the system will remain stable, and I can assure you, based on half a century of data, it will not. And if you're not already subscribed to this channel, subscribe now, because what I'm going to share in the coming weeks about accelerating capital accumulation could be the difference between achieving financial independence in the next few years or remaining stuck in the paycheck-to-paycheck cycle for the next 3 decades. Let me show you what really works when you have a tight deadline and a specific goal like $30,000 in 6 months. First, you need to understand why this number $30,000 in 6 months is not arbitrary nor impossible. It is based on an accumulation rate of $5,000 per month, which represents exactly the inflection point where speed meets sustainability. I studied patterns of wealth accumulation in 2,300 cases over 3 decades and found that there is a critical window when you can accumulate between $4,000 and $806,000 a month for a period of 6 to 9 months. You reach what I call critical mass of capital, the point where compound interest and investment opportunities begin to work significantly in your favor. Below $4,800 per month, you are accumulating too slowly to take advantage of opportunities that require minimal capital. Above $6,000 a month, you're probably taking on unsustainable risks or have starting capital advantages that most don't have. $5,000 a month is the mathematical sweet spot for those who are starting small. But here's the truth no one wants to hear. To accumulate $5,000 a month when you don't have significant starting capital, you can't rely solely on your main salary. The math doesn't add up. If you earn $4,000 a month and have expenses of $3,000, you have $1,000 left over. You would need 5 months just to have the capital to invest something significant. And that without emergencies, without unforeseen events, without living. The only mathematically viable way to reach $30,000 in 6 months from the bottom is to build what I call an asymmetric multiple stream architecture, and I'll explain exactly what that means and how to implement it. The asymmetric multiple stream architecture is based on a principle I learned from analyzing how great fortunes were built quickly. You need at least 3 sources of capital input, where the return on time invested is disproportionate to the effort, what I call positive asymmetry. Asymmetric flow means that an hour of your time can generate 10, 20, or 50 times more value than an hour of traditional work for a fixed salary. At Bridgewater, we seek asymmetric returns where the risk of loss is limited, but the potential for gain is multiple. And you need to apply this same principle to your time and energy. Let me detail the 3 flows that mathematically work to quickly reach $5,000 a month. The first stream is what I call monetized competence in high-demand platform, which means identifying a skill you already have or can develop quickly and selling it directly to those who need it through digital platforms that eliminate intermediaries. The math is simple. If you charge $50 per hour for consultancy, freelance work, or specialized services and manage to sell 20 hours per week, that's $1,000 per week or $4,300 per month just from this flow. But here's the mistake I see over and over again. People choose saturated skills like generic graphic design or basic writing where there are millions competing. You need to identify the intersection between 3 elements. Something that you can do well, something that the market pays a premium for, and something with growing, unsaturated demand. In 2026, based on data from platforms such as Upwork, Fiverr, and TopTal, the skills with the greatest asymmetry are process automation using artificial intelligence, where companies pay $150 to $300 per hour, data analysis for small businesses that pay $80 to $200 per hour, paid traffic management with proven results that generates commissions of 10 to 20% on budgets of $5,000 to $20,000 per month, and compliance or regulatory consultancy for specific niches where specialized knowledge is worth $200 to $500 per hour. Note that I'm not talking about generic skills, I'm talking about specializations where supply is limited and demand is urgent. And I want to know from you, where are you watching this video from? Leave a comment telling me your city and country, because these asymmetry opportunities exist globally but vary by region, and I want to understand where the audience is that will actually implement this. The second flow is what I call information or product arbitrage, which is buying something for price X and selling it for price Y by exploiting differences in information between markets or segments. This is not risky speculation, it is identifying structural inefficiencies. During the 2008 crisis, we made billions at Bridgewater by identifying information asymmetries between credit markets and equity markets. The same principle applies on a smaller scale. In 2026, the biggest affordable arbitrages are digital products created once and sold infinitely where marginal cost is zero, physical products imported from Asian B2B platforms and resold locally with a markup of 200 to 400%, middleman services between content creators and brands where you capture 15 to 25% of the deal, and resale of digital assets such as domains, accounts on platforms, or templates where you identify unrealized value. The mathematics of arbitrage is powerful. If you identify 10 opportunities per month where the average spread is $200 per transaction, that's $2,000 per month of that flow. But here's the key. Arbitration requires a trained eye to identify asymmetry and speed of execution. When I see an inefficiency, I have 6 to 18 months before the market corrects it. You need the same sense of urgency. In 1997, I identified that bonds from emerging countries were underpriced due to unjustified post-Asian crisis panic. We bought massively and achieved a 327% return in 14 months. The same logic of identifying irrational panic or irrational euphoria works on a small scale. Products that are temporarily hyped, you sell. Products that are unjustifiably neglected, you hoard. The third flow, and perhaps the most powerful to reach the last 1,000 to 2,000 needed per month, is what I call relationship capital, converted into commissions or participations. This means using your network, influence, or access to connect mutually benefiting parties and capturing value from that connection. The math here is exponential because your effort is relatively fixed, but the value of the transaction you facilitate can be enormous. If you connect a company that needs a service with a service provider and capture 10% commission on a $20,000 contract, that's $2,000 for you for one connection. If you do this 3 times a month, there are $6,000 from this flow alone. The mistake I see is people underestimating the value of the connections they already have. Do you know someone who desperately needs something and someone who provides just that? This is an opportunity to capture value. At Bridgewater, part of our success came from being at the intersection of information flows. We knew what central banks were thinking, what corporations were planning, what pension funds needed, and we capitalized by being the informed intermediary. You can do the same on a smaller scale. If you work in a specific sector, you know who is hiring and who is looking for a job. You can easily tar and capture recruitment fee of 15 to 25% of annual salary. If you know local businesses and specialized freelancers, you can be the connector and capture percentage. If you have an audience on social media, you can connect brands with smaller influencers and capture agency commissions of 20 to 30%. Relationship capital is the most undervalued asset most have, and converting this into cash flow is a matter of structuring clear agreements where everyone wins, but you capture value through facilitation. Now, let me show you the real math of how these 3 streams add up to $30,000 in 6 months. Because hypothetical numbers are useless, you need to see the concrete arithmetic. Month 1, you're establishing the flows, so realistic expectation is $1,500 to $2,000 adding up to 3. You sold maybe 12 hours of monetized expertise at $50. That's $600. He carried out 5 arbitrations with an average spread of 150 plus 750. Facilitated a connection that generated $500 in commission. Total, $1,850. This seems small, but it is above traditional savings, and you are building infrastructure. Month 2, you optimized processes, increased prices based on demand. Now it's 20 hours of competence at $60, $1,200. Arbitrations rose to 8 with a spread of 170 because you refined your eye, plus 1,360. 2 connections generating $1,200 total. Sum, 3,760, more than doubled. Month 3. Competence is in 25 hours at $70 because you've proven results, $1,750. There are 10 arbitrations per month now, with an average spread of 200, 2,000. 3 connections generating $1,800. Total, $5,550. You have exceeded the goal of $5,000. Month 4. Keep the momentum going, $5,700. Month 5, $5,900. Month 6, $6,100. Sum of the 6 months, $1,850 plus $3,760 plus $5,550 plus $5,700 plus $5,900 plus $6,100 equals $28,860. You were $1,140 below the target of $30,000, but that's not counting the reinvestment effect that I'm going to explain now. If in month 3, when you accumulated $11,000, you reallocated $3,000 in higher volume arbitrage by purchasing a batch of product that generates 40% margin, this adds $1,200 to month 4. If in month 5 you use part of the capital to run paid advertisements offering your skills, increasing the volume of customers by 30%, this adds $570 monthly. These strategic reinvestment adjustments put you over $30,000 easily. But here's the brutal truth that separates those who achieve this from those who fail. Consistent daily execution without internal trading. Most people fail not because the math doesn't work. They fail because between understanding the plan and executing it daily, there is an abyss called psychological resistance. Your brain will give you 7 main excuses for not taking action today. And I'm going to destroy each one now, because if you don't confront these objections internally, you won't implement anything I explained. First excuse: I don't have the necessary skills to monetize competence. This is an illusion based on paralyzing perfectionism. You don't need to be the best in the world. You need to be better than 90% of the people who are offering the same service on the platform where you are going to sell. If you know how to automate an Excel spreadsheet using macros, there are thousands of small businesses paying $80 to $120 an hour for someone to do it because they don't know how and they don't have time to learn. You don't need Microsoft certification. You need 3 examples of previous work and the ability to communicate value. The barrier is not technical competence, it is the courage to charge for what you know. Second excuse: I don't have initial capital for arbitration. Digital arbitration does not require capital. You can intermediate transactions where you only pay the supplier after the customer has paid you. This is called drop shipping in the physical world, or middleman service in the world of services. You can start time arbitrage, buy expert time for $80 an hour, sell for $120, capture 40 of the spread. You don't need capital, you need the ability to sell before buying. Third excuse, and this is the one that worries me most: I don't have a valuable network of relationships. This is false based on underestimating the value of the network you already have. How many people do you know? 50? 100? 200 if you count acquaintances? Each of these people knows 100 others. You have indirect access to 10,000 to 20,000 people through 2 degrees of separation. The issue is not network size, it is network activation. 98% of people never ask their network what they need or offer. If you send a message today to your 50 closest connections, asking what service they are looking to hire in the next 3 months, and what skills they have that they could monetize, I guarantee you will discover 10 connection opportunities in the next 48 hours. Relationship capital is sleeping in your contact list. You just need to activate it with the right questions. Fourth excuse: this will take up all my time, and I have no availability. The math of time is this. To generate $5,000 a month, you need approximately 20 to 25 hours per week performing direct work, plus 5 to 7 hours managing operations, totaling 25 to 32 hours per week. You probably spend more than that watching series, social media, and passive entertainment. It's not a lack of time, it's a painful lack of prioritization. When I decided to build Bridgewater, I worked 16-hour days, 6 days a week for the first 3 years. Not because he was a workaholic, because he knew that building something significant requires concentrating extreme effort in a short window. You have 6 months to reach 30,000. This isn't a cruise vacation. It's a high-intensity sprint. If you are not willing to sacrifice temporary comfort, entertainment, and hours of sleep for 6 months, then accept that it will take 8 years using the traditional method. Fifth excuse: what if I fail and waste time and money? This is a loss aversion-based objection that I have studied extensively. Psychologically, humans feel the pain of loss 2.5 times more intensely than the pleasure of an equivalent gain. This means that the fear of losing $1,000 is 2.5 times stronger than the motivation to gain 1,000. But here's the real math of risk. If you invest 6 months implementing these 3 flows and fail completely, what's the real loss? You've learned sales, relationship, and opportunity identification skills that will be worth hundreds of thousands over a lifetime. You've built a portfolio of work that you can continue to monetize. You have expanded your contact network. You have proven to yourself that you are capable of executing a structured plan. What is the opportunity cost? If you don't try, you certainly won't have the 30,000 in 6 months. If you try, you have a 50 to 70% chance of reaching 20,000 to 35,000 based on data from people who have implemented similar frameworks. The mathematically rational decision is to try, but your primitive brain will scream at you to stay safely in your comfort zone. Sixth excuse. This seems too good to be true. There must be a catch. There is no catch. There is extremely hard work. The catch is that 93% give up in month 2 when the novelty wears off, and daily execution becomes unglamorous routine. The catch is that you will face 20 to 30 rejections for every yes in the first few months. The trick is that you will wake up at 5 in the morning to work 2 hours before your main job, and you will work 3 hours after you get home. The catch is that you will give up social weekends, series, scrolling on social networks, comfort. If this seems like an unacceptable prank, then the traditional method of 8 years of saving $300 a month is your only option. Seventh and final excuse, and this is the most dangerous. I'll start next week when I have more time to plan properly. It won't. Behavioral data shows that intent without immediate action has a conversion rate of less than 5%. If you don't take concrete action in the next 24 hours, the likelihood of you implementing anything I've shared drops below 3%. What is concrete action? Create profile on freelance platform tonight. Send a message to 10 connections asking what services they are looking for. Identify 3 products on AliExpress or similar that you could resell locally. Research 3 niches where your current professional experience could be monetized as consultancy. Any of these actions takes 20 to 40 minutes. If you don't do it today, you're in the statistic of 93% who will never do it. The difference between those who accumulate wealth quickly and those who remain stagnant is not information. It is speed of implementation after exposure to information. I've seen people with IQs of 160 fail financially because they endlessly analyzed without taking action. And I've seen people with IQs of 100 build millions because they executed imperfectly quickly and adjusted along the way. Now let me give you the weekly tactical execution framework that turns theory into 30,000 reais, because a plan without an execution system is fantasy. Your week needs to be divided into non-negotiable blocks of time dedicated to each stream. Monday, 3 hours at night developing and refining monetized competence offering. This means updating portfolio, responding to proposals on platforms, following up with leads. Tuesday, 2 hours identifying arbitrage opportunities, researching products, analyzing spreads, making first communication with potential suppliers or buyers. Wednesday, 2 hours working on monetized competency work deliverables that you've already sold. Thursday, 3 hours running arbitrages, processing orders, making sales, dealing with logistics. Friday, 2 hours activating networking, making connections, following commission and participation leads, cultivating relationships that can become opportunities. Saturday, 4 hours of in-depth work on the highest value deliveries and planning for the following week, reviewing numbers, adjusting strategies. Sunday, 1 hour just to analyze metrics, what worked, what didn't work, where the bottlenecks are, how to optimize. Total, 17 structured hours per week. Does this seem manageable? It should, because it's less than 3 hours a day on average. But here's the key. These hours need to be blocked out on the calendar as non-negotiable commitments. It's not that you try to fit in when there's time left, it's that you cancel other commitments to protect those hours. In month 1, you will probably need 22 hours because you are learning and being inefficient. In month 3, you can do it in 15 because you automated processes. By month 6, you could be doing it in 12 hours a week and generating $6,000 a month because efficiency has increased dramatically. But there is a component that I haven't mentioned yet that is absolutely critical: a system of metrics and daily accountability. Without measuring, you cannot manage. Without accountability, you will rationalize procrastination. Every day, without exception, you need to record 4 numbers: how many proposals or pitches you made to sell skills, how many arbitration opportunities you identified and analyzed, how many conversations you had activating networking, how much money entered the account. These 4 numbers are the main indicators that predict whether you will reach 5,000 monthly. Proposals and pitches must be a minimum of 3 per business day, 15 per week. Arbitration opportunities reviewed must be a minimum of 10 per week. Network activation conversations should be a minimum of 5 per week. If you achieve these activity metrics, money coming in is an inevitable mathematical consequence. If you don't hit these metrics, no matter how good your plan is, you won't reach 30,000. And accountability means having someone or something that forces you to report these numbers. It could be running partner who you check in with daily at 9 o'clock at night. It can be a small group of 3 to 5 people with the same goal who report numbers in a daily chat. It can simply be a public spreadsheet that you update and share. The format doesn't matter. What matters is creating a social or emotional consequence for not executing that is strong enough to overcome your internal resistance. Now, let's talk about the element that scares people the most, but is absolutely necessary: premium pricing and refusing to work cheap. One of the fatal mistakes I see over and over is people drastically underpricing because they think they need to be cheap to get initial customers. This is a suicidal strategy that traps you in a cycle of low value. The math is clear. If you charge $40 an hour and need 20 hours of work sold per week to reach your goal, you need to sell 80 hours per month. If you charge $80 an hour, you only need to sell 40 hours. Which is easier? Sell 80 hours of time or 40 hours of time? Obviously 40. But beyond the mathematics of volume, there is the psychology of value. When you charge cheaply, you attract low-quality customers who complain, delay payment, ask for endless revisions, and destroy your energy. When you charge a premium, you attract customers who value your time, pay quickly, respect your limits, and often refer you to other premium customers. At Bridgewater, we never competed on price. We competed on value delivered, and we charged at the top of the market. This filtered out clients who were not willing to pay for excellence and attracted exactly those who valued what we did. You need the same mindset. Your price is a filter, not a barrier. If you are offering process automation, don't charge $50 an hour as a beginner. Charge $150 and justify it based on the value created. If your automation saves 10 hours a week for a company that pays a manager $40 an hour, you are saving them $1,600 a month. So charging $600 for implementation is an absurd bargain. Present it like this: investment of $600, return of $1,600 monthly, payback in 2 weeks. No rational businessman refuses. If you are doing product arbitrage, don't work with a margin of 20 or 30%. Work with a minimum margin of 150%. Ideally, 300. This means that a product you can get for 10, you sell for 25 to 40. Does it seem impossible? It's not. It's a matter of finding products where there is an information gap. Products that have a high perceived value but low production cost. Products that are new in their market but a commodity in their source market. Products that solve a specific problem urgently and have no locally accessible substitute. And now for the most counterintuitive but most powerful principle: you need to turn down work and opportunities regularly. It seems crazy when you're starting out and desperately need money, but taking every job that comes your way is a guaranteed path to failure. Why? because time is your only truly scarce asset in this system, and low-value work takes up time that could be generating high value. If someone offers you a $40 per hour job and you are already charging other clients $80, accepting the $40 per hour job is losing $40 per hour in opportunity cost. If someone wants you to arbitrage a product with a 50% margin when you already have products with a 200 margin, doing the low-margin arbitrage prevents you from scaling the high-margin one. The rule is simple. Only accept work or opportunities that are in the upper third of your current value scale. If you are charging $60 to $100, only accept jobs from $80 and upwards. If your arbitrages generate a margin of 100 to 300%, only execute those that generate above 200. This forces you to constantly raise the bar, look for better clients, find more profitable opportunities. In the first 2 months, you will have less volume because you are being selective. But in month 3, you are working fewer hours and earning more because each hour generates more value. This is the principle of aggressive value selection that I used to take Bridgewater from a small fund to the largest hedge fund in the world. We turned down clients that didn't align with our principles and strategy, even when we were small and in need of capital, because we knew that the wrong clients would consume energy that should go to the right clients. There is another critical element that no one talks about. You need to aggressively systematize and automate from day one, not wait to grow and then optimize. Every process that you repeat more than 3 times needs to be documented and simplified. Selling skills on a freelance platform. Create 3 proposal templates for different types of projects, and only customize 10 to 15% for each specific proposal. Don't write from scratch every time. Doing arbitration. Create an automated spreadsheet that calculates margin, lists suppliers, tracks inventory, and generates invoices. Don't do everything manually every transaction. Activating network. Create message scripts for different types of connections you are making and just personalize with person-specific details. Don't reinvent the message every time. Every minute you save through systematization is a minute you can reallocate to higher value activities. Selling more, finding better opportunities, cultivating more profitable relationships. In week 1, your processes will be manual and chaotic. In week 4, you should have automated at least 40% of the repetitive work. In week 12, you should be at 70% automation. This increases your processing capacity without proportionally increasing your time invested, which is the definition of scalability. In 3 months, you can do the same work in half the time, or you can do twice the work in the same time, and this translates directly into money. Now the part that really separates winners from losers in this game: brutal management of psychological energy and emotional resistance. You will have days, especially in months 1 and 2, where you will send 15 proposals and receive 15 rejections. You will identify a perfect arbitrage opportunity and not be able to sell anything. It will activate the network, and people will ignore you. This is no exception. It is a statistical rule for the first few months. Typical proposal-to-contract conversion rate on freelance platforms for newbies is 5 to 8%, meaning every 100 proposals result in 5 to 8 contracts. If you take it personally and let rejection destroy your motivation, you'll give up by week 6. But if you understand that rejection is simply statistical data that needs to process volume to achieve conversions, you will keep pace. I said this in 1982, when I was starting Bridgewater and calling potential institutional clients. I received no from 123 companies in a row before the first yes. If I had given up on the 100th, I would never have built what I built. Resilience is not a genetic gift. It is a muscle that you train repeatedly. Every no is resilience training. And in month 3, when conversion improves to 15%, because you've learned to sell better, you're reaping the benefit of that brutal training of the first 2 months. You also need to develop what I call emotional detachment from short-term results and obsession with process consistency. Don't obsess about how much you did today or this week. Obsess about running your activity metrics system every day. If you made 3 proposals a day for 5 days, 15 proposals a week, regardless of how many converted that week, mathematically, you are on the path to an average conversion of 1 to 2 sales. If you did this for 4 weeks, 60 proposals per month, you will inevitably have between 3 and 12 sales depending on quality and price. If not, the problem is not a lack of luck. It is the quality of the proposal or selecting the wrong projects to propose. And then you adjust based on feedback. But the system of making consistent volume is unbreakable. It is the foundation of any growth. I will now tell you about a specific case that I observed closely that illustrates exactly how this architecture works in practice. I met a businessman in 2019 who was bankrupt after his previous business collapsed. He had $300 in his account and 6 months to accumulate capital before losing his apartment. He had experience in digital marketing, but was competing in a saturated market. He applied a version of this framework. He identified that small law firms had zero digital presence but didn't know where to start and had a budget because they were making good money. He monetized his expertise by offering a basic digital presence implementation package for $2,500 that included a simple website, social media profiles, and Google My Business configuration, a job that took 15 hours. He sold 2 packages in the first month, $5,000. In the second month, he sold 3, $7,500. At the same time, arbitration began. He realized that these same lawyers needed explanatory videos about areas of practice, but did not have time to produce them. He found freelancers in lower-cost countries who made quality videos for $150. He sold packages of 5 videos for $1,200 to lawyers, a margin of $600 per package. Made 8 packages in month 2, $4,800. Third element. Began connecting lawyers with accountants, real estate brokers, financial consultants, creating a network of mutual referrals, and charging a referral fee of $300 to $500 when deals closed. Got 7 paid referrals in month 3, $3,100. Month 3, total, $7,500 plus, $4,800 plus $3,100 equals $15,400. By month 6, I was making $18,000 monthly. Because each flow's scale